All right. Good morning, everyone. I'd like to call a meeting to order and acknowledge that we're in Treaty 1 territory, the home and traditional lands of the Anishinaabe, Ojibwe, Innu, Cree, and Dakota peoples, and the national homeland of the Red River Métis. Our drinking water comes from Shoal Lake 40 First Nation and Treaty 3 territory. My name is Neil Harden. I'm chairing today's panel. With me are Diane Knight and Linda Schultz. The assessor today is Sharon Tang, and the administrative personnel is Zachary Mohan. To the Zoom participants of the hearing, please note you are placed in the waiting room until your property is called upon. When it is your turn, you will be admitted into the meeting. Kindly follow along on the City of Winnipeg's Board of Revision YouTube channel for the hearing process. Once the host admits you into the hearing, please close or mute your YouTube player. You will then be permitted to speak with respect to your property. Once your hearing has concluded, you can leave the meeting. We will be hearing applications for revision of the assessment rule in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and we will limit discussion to those matters. The statements that are made at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by the board. The board is appointed annually by council and is independent of it and the city administration. It makes its decisions on the basis of the evidence prior to this hearing and issues a written order that be mailed to all parties as soon as possible. Please note that the board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of King's Bench if the matter pertains to the applications of exemptions from taxation. Should you wish to appeal, information will do so will be included with the board's order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony followed by questions the applicant may have, then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the board will deliberate in private and make its decisions. You'll receive the board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. We'll be hearing items 1 through 5 on the docket today. Mr. Mohan, please affirm the assessor's and applicant's testimony.
Of course, Mr. Chair. Madam Assessor, please state your full name.
Sharon Tang.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you. Mr. applicant, please stand. Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you. You may be seated.
Okay, so the first property on today's agenda is 65, is it pronounced Paget Street? So Ms. Teng, you can proceed.
File number is 24-3872. Roll number is 1000642160. Address is 65 Paget Street. The assessed value for 2025 is $12,951,000. Page 2 of my brief shows the subject property information. So there's one building on the property and it's 6-story tall, and it was built in 2008. There are 62 suites, 62 indoor parking, and 19 outdoor parkings. Page 3 of my brief shows the subject property photos. And page 4 shows that there's no sales history for the subject property. And page 5 shows the workup for the value. So there are 62 two-bedroom suites, and we assigned a monthly rent of $1,610.91. Then we use a vacancy rate of 3.1%, expense ratio of 47.03%, and then we use a cap rate of 4.75%. And that gives us a market value of $12,951,000. And page 6 of my brief shows the comparable rent for the subject property. And page 7 and 8 of my brief shows the CMHC information. So I used the 2022 version of the CMHC information. And in 2023, CMHC split 2005 plus category. So there are two categories, which is 2005 to 2014 and 2015 plus. So if I were using the 2023 version of the CMHC information for October 2022, our model rent is about 111.17% of the CMHC information. And page 9 and 10 of my brief shows the cap rate evidence. And page 15 and 16 of my brief shows the property amenities and the income and expense information. And that's my presentation.
Okay, questions, Mr. Newman?
Yes, thank you. Good morning, Ms. Tang. If you look at your page 3 in the upper photo, so that's the overhead view. And this property does not have direct access to Paget. Is that correct?
That's correct.
And it must travel over property owned by adjacent landowners, correct?
That's correct.
And that's unusual where an apartment building will not have direct access to a public road. In your experience, do you see that very often?
I guess not.
All right. Now, page 5, which is the calculation of your value, that's entirely model driven, correct?
That's correct.
And then page 6, you reference a number of comparables. Comparables 1, 2, 3, and 4, they are all built in 2013, 14, 15, or 16, correct?
That's correct.
So they are all younger than the subject property.
That's right.
Then page 7. So this is a collection of CMHC data, and it continues on to page 8. And just so the board understands, CMHC publishes a variety of statistics about apartment buildings across Canada, correct?
That's right.
And they publish data on Winnipeg as well. And what they do is they segregate that data by different criteria. And so in the top half of page 7, that is the segregation of the rents in the fall of 2022 by geographic zone. And zone 11 is Fort Garry, correct?
That's correct.
And so what this tells us is that for buildings in Fort Garry, the rent for 2 bedrooms is averaging $1,418, correct?
That's correct.
Then in the lower half of the page, this is a different type of data segregation. And this is CMHC as you put it down here. And I know you explained this, and I'll come back to that. But what you were reflecting in the lower half of page 7 was the CMHC data for buildings built 2005 and later, correct?
That's correct.
But you and I had a conversation yesterday, and I suggested to you that in fact, CMHC was now doing a further segregation, and they were now reporting buildings 2005 to 2014 as one group, and then buildings 2015 and later as a second group, correct?
That's correct.
All right. And so when you spoke earlier in your evidence about the split between 2022 and 2023, you didn't indicate what that split shows by way of the rent. And is it correct that for buildings built 2005 to 2014, CMHC says the rent is $1,506.
That's correct. That's why the percentage rent for the model compared to the CMHC increased from 108.31% to 111.17%.
Yes, and I understand that, but I just want to be sure the board understands, but thank you. And then on to page 8. This is another form of data segregation that CMHC does, top half. And this is where they segregate based on the size of the building, the number of units in the building, and that's telling us that the rents were $1,423.
That's correct.
All right, so then in the lower half of the page, you've got the combined averages. And what you would do now is the $1,621, which is based on year of construction, that would change to $1,506, correct?
I'm sorry, what was the number again?
$1,506.
Yes, that's correct.
Right, and that the effect of that is that the average would change to $1,449.
That's correct.
Okay, and so then down below, what you're showing is you're doing a comparison between the modeled rent and the potential rent under CMHC data. And originally you were saying that the yearly potential rent based on CMHC was $1,106,000. And that the model was about $92,000 higher than that. So it was 108% above, or 8% above the CMHC rent. But that number would change as well, and the new yearly potential rent would become $1,078,000, correct?
That's correct.
Okay. Did you check the questionnaire submitted for this property in terms of what the rents were in 2022?
No, the property is a life lease property, so we don't take into consideration of the subject property information.
But you agree with me that that questionnaire, so you're saying you didn't look at it at all?
I guess just briefly, but we not in details.
All right, so I'll leave that alone then. Then page 9 is your cap rate. Let's go to page 10. And you didn't really speak to this, but this is some information the department's been putting forward on apartment properties. To be clear, as it says at the end of the first paragraph, this data is not meant to be comparable specific to the subject property, correct?
That's correct.
And these properties, there's 12 of them in total. The great majority of them are built in the 50s and 60s, correct?
That's correct.
There is one built in 2015, 2390 McPhillips. There's one built in 1913, 677 Maryland. But generally, these are older buildings. Would you agree with me as well that they are generally much smaller buildings?
I do.
In fact, 4 of the buildings have single-digit units, either 8 or 9 units. So would you agree with me that generally speaking, this information is not a very good set of comparables for the subject property?
I think we'll be putting more weight on the 2390 McPhillips that is more compatible to the subject property, which has 4.71% cap rate.
Okay, so let's talk about that. So you know, I expect that there's a significant difference of opinion between the department and people on my side of the table as to what the capitalization rate on that property should be. Are you aware of that?
A little bit.
Yeah, a little bit. And I'm not sure whether you're understating that or whether that's truly the case. But you're aware of the fact that at least it's been reported, and you're aware that it's been reported that the buyer, upon acquiring this property, was able to move the rents up and significantly change the net operating income. You're aware that that's what's been reported, correct?
A little bit, yes.
All right. Okay, those are my questions. Thank you.
Okay, Ms. Knight, any questions?
No, one of my question was asked and answered.
Ms. Jules?
Nothing at this time, thank you.
Okay, I guess I have no questions that haven't been asked and answered, so Mr. Newman, you can give your presentation.
And Mr. Chairman, I have rebuttal as well, brief rebuttal. Frankly, a lot of it's been covered in my cross of the assessor. When would you like me to bring that forward? When I'm done my main presentation?
You will do your main presentation and we'll have questions on that, then you can do your rebuttal.
All right, thank you. If you go to page 2 of my presentation, I just recite a little bit of the background and history. The assessor, as we know, is using $1,610.91 a month as the rent. I think that's somewhat high. I'll speak to that in a moment. 2 issues for you to decide ultimately: the net operating income, which is in turn a function of the gross potential income. I'm not disputing vacancy. I'm not disputing expense ratio. So it becomes a question of what is the appropriate rent. And that in turn will lead to the net operating income. And then the other issue is the capitalization rate. If you go to page 3 of my brief, the 2022 questionnaire reflects a monthly rent of $1,449. This is in fact what the tenants are paying in this property. I then indicate that CMHC reports 2-bedroom rents in Assiniboine Park at $1,532. And the assessor and I spoke yesterday about 2 things. One, the question of the CMHC data in her brief, and I realized that I'd made an error in my brief by referencing Assiniboine Park, because in fact, it's not Assiniboine Park, it's Fort Garry. And the Fort Garry rent, as we've heard, is $1,506, not $1,532. And we also, I'm sorry, I've got that number wrong. The Fort Garry rents are $1,418, not $1,506, not $1,532. It's $1,418. So that's a correction I'm making based on being Fort Garry, not Assiniboine Park. Then buildings built between 2005 and 2014 is $1,506 a month. I then suggested the rent should be adjusted downward to $1,532. And that was driven by the error I had made in believing that we were in Assiniboine Park. And I'm actually going to adjust the rent to $1,449. And I'll show you in a moment what I'm doing and how I'm getting there. As I said, expense ratio is not disputed, neither is the vacancy. So let me turn to capitalization rate, 4.75%. Let's understand that as we come to April 1 of 2023, and I'm at page 3 of my brief and going on to page 4, interest rates have moved up significantly. Interest rates are an important component of the real estate economy. Interest rates are an important component of capitalization rates. If you're an investor looking to buy GICs in April of 2023, you can easily get a rate over 5%. Here we've got a rate below that. So what I do is that at page 4, page 5, page 6, I speak to the fact that capitalization rates are moving because interest rates are moving. And you can see at the bottom of page 4, the chart that shows how interest rates moved up by 425 basis points between April 1 of 21 and April 1 of 23. So that should lead to, in the normal course, to an increase in the capitalization rate. You see on page 5, a chart dealing with bond rates. Mortgage rates are always tied to bond rates, and ultimately they're all interconnected. You see at page 6, a chart referencing average capitalization rates nationally, and you can see that they are starting to move up, not down. You see at the bottom of page 6, the commentary by Colliers that cap rates in Winnipeg have begun to increase because of the rising rate environment. And so capitalization rates are impacted by a variety of factors. At page 9, I make reference to the fact that Altus has done an extensive study, and in their opinion, buildings built 2005 should have capitalization rates in the range of 5 to 5.75%. In a general sense, as I'll show you in a moment, that's consistent with what the brokers are reporting as well. And if you go to page 11, you'll see the Colliers information from Q1 of 2023, indicating 5 to 6%. You'll see as well at page 13, a reference to rent control. There was no increase in rents allowed in 2022, 1.6% in 2021. And then at page 14, I address how the brokers categorize buildings. Cushman Wakefield, in their opinion, a high-rise building is something greater than 80 units. And you can see that for low rise, they put the range of cap rates at 5 to 5.75%. CBRE says high rise will be 5 stories and above. They put the range of rates at 4.75 to 5.25 on B buildings. So what we've got is a range of rates I'll indicate to you ultimately, where Altus is suggesting 2005 plus buildings are 5 to 5.75. Colliers is at 5 to 6%. Cushman Wakefield is at 5 to 5.75 on low-rise buildings, and CBRE is 4.75 to 5.25. This building, very unusually, is a landlocked building. It does not have direct access to the public roads to Paget. It must cross the property of an adjacent property owner. That changes the risk equation I suggest to you. It also leads to increased operating costs because now they've essentially got an internal roadway, which they don't own, but which they have to be responsible for some of the costs of maintenance and snow clearing because it's not a public road, unlike most apartment buildings, all that I'm generally aware of, which have direct access. So what I then do is I do a calculation of value, and I drive it by the rent of $1,532 a month, which I'm correcting, and I'll show you that as part of my rebuttal. And I'm applying a 5.25% capitalization rate, and that would have resulted in a value of $11,143,000. As I said, I made a mistake in terms of the geographic area that this building was located in. Recall that when I examined the assessor and her chart on page 8 of her brief, which recorded and summarized all the CMHC data, the average rent based on CMHC, the zone, the year of construction, and the number of units in the building comes to $1,449. By coincidence, purely, that's actually the rent that's reflected in the questionnaire as being charged to the tenants of the building. That's what I'm going to show you ultimately in my rebuttal, a revised calculation. It's interesting that the assessor's model at 111% is 11% above the CMHC rents, which strikes me as a pretty significant variance. So subject to the right to present the rebuttal to you, those are my submissions, and I'll await questions.
Okay, questions, Ms. Ting?
I'm sorry, I didn't catch the valuation part. So what was the monthly rent that
So what I'm going to do is, as I said earlier, I made an error by selecting Assiniboine Park geographic area rent when I should have been working with Fort Garry. And as we've heard, Fort Garry is $1,418. And I then made reference to your page 8 and your summary of the CMHC data, where your average initially was $1,487, but once the age of construction number of $1,621 is corrected to $1,506. And I'll simply say to the panel, I've made all of this visual in my rebuttal, so you'll be able to see it. But once that $1,621 is corrected to $1,506, the average then becomes $1,449. I indicated by coincidence that the rent reflected in the questionnaire is being charged to the tenants. And the end result is that the assessor's model is 11% higher than the CMHC data would suggest. And to me, that's a significant variation. And that's where I stopped. And I said, I'm open for questions.
okay, so the rent that you assigned that you suggest would be $1,449?
Yes.
Okay. So I'm just wondering, are you aware of the size of the 2-bedroom apartments that CMHC reported for Fort Garry area?
In a general sense, yes, they do vary, obviously, and there is some smaller and there is some larger.
Okay. Okay. On page 11 of your brief, so it shows a Collier Q1 2023 cap rate study.
Yes.
Sorry, are you aware that Collier uses the net operating income for the 12 months following the date of sales divided by the purchase price?
No, I'm not aware of that.
Okay. And for the cap rate study, do you have any actual sales to support your 5.25% cap rate?
What I have is I have the spectrum of the combination of the data reported by the brokers, the 3 different brokerage firms, and reported by Altus. That's my data. Altus does report individual sales to ultimately come to their conclusions as to capitalization rate. So in that sense, through the Altus information, there are individual sales being reported.
I don't have any other questions.
Okay, Ms. Schultz, any questions?
Not at this time. I'll wait for the rebuttal.
Okay, Ms. Knight, any questions?
Not at this time, thank you.
Okay, Mr. Newman, is this a life lease building?
It is.
So the rents reported might be artificially low then?
Well, they might be. My experience in terms of what's been happening with life leases is that the costs are actually bringing the rents actually up to market. In theory, when it started out many years ago, that was a good theory. I don't think it's really achieving that end result these days.
Okay, all right. So then, do we, Mr. Mohan, do we have the rebuttal in the docket yet?
Yes, Mr. Chair, it should be in the SharePoint. You might have to refresh it. It'll be listed as item 1, the file name 65 Pagat Street, applicant rebuttal. That's the name of the document.
Okay, it's not
And Madam Assessor, you got it as well. I emailed you a few moments ago.
Okay,
Yeah, I got mine already.
It's
Okay, perfect.
updated, Yeah,
let me just read.
it's there now.
Okay, okay. Okay, so on the rebuttal then, Mr. Newman.
So as I said, I think frankly, a lot of this has been covered already but it just puts to paper much of what you've heard. So on page 2, what I do is I reference, I believe there's an error in the assessor's brief. And CMHC data shows that by year of construction, the rents are $1,506. And I've taken a screenshot and you see that portion of the table in approximately the middle of the page. And again, it's simply a function of the fact that at one point, CMHC simply reported a single data set, construction 2005 and later. And then they've since segregated that into construction 2005 to 2014, and then construction 2015 and later. And more recent, I should say. And that's important, of course, because as construction costs go up, it simply means that the starting rents have to be much higher to cover the cost of construction. So this building built 2008, the CMHC rents are $1,506. What I then do is I reflect the fact, and again, we've talked about this, that change has an impact on the assessor's average. So the assessor at page 8, relying on the CMHC data, zone for 1418, year 1621, and unit count 1423, that average became $1,487. But the 1621 was an error, as we've heard. The proper data is the 1418, the 1506, and the 1423. So the corrected average becomes $1,449. On to page 3, as I told you, I made an error in that I selected the Assiniboine Park zone when in fact the building's in the Fort Garry zone, and the rent there is by zone $1,408. That in turn caused me to select an improper rent. And I'm now saying the rent selected should be $1,449. And then what I do on the last page of my brief is I simply put to paper the calculation of that so that it's visible to you. And it comes to $10,539,000. And as I said earlier, this simply gives you a visual of much of what you had already heard through the evidence. And that's my rebuttal, and I'm open to questions.
Okay, questions, Ms. Ting?
Just one, I guess. So I guess for the subject property, I guess according to my brief, each unit is about 1,656 square foot for 2-bedroom unit, and we assign a rent for $1,610.91, which is equivalent to about 97 cents per square foot. So I'm just wondering if you have any actual data to support the CMHC rent or to show any rent that is compatible to the subject property.
So just so I'm clear, at the outset, I think you said that the units are 1,656 square feet. And
That's
that
correct.
calculates to 90 odd cents a square foot.
That's correct.
I think that's the premise. Of course, that's the gross area of the building. So that's going to include elevator lobbies and corridors. That's not actually the size of the units, correct?
That's correct.
All right. But having said that, just so we're clear on that, no, I don't have data on a per square foot basis.
Okay, I don't have any questions.
Okay, Ms. Knight, any questions?
Um, so really we're down to a decision about the cap rate and the NOI, correct?
That's correct.
Okay, I'm not gonna ask any questions, thank you.
Okay, Ms. Schultz.
So the correct rent that we're working with is the 1449.
That's what I would like you to work with, yes.
Oh, yes, sorry, that's what you have in your rebuttal, correct. Okay, no, that's fine, thank you.
Okay, Mr. Newman, what is the average size of the two-bedroom apartments in the CMHC studies?
I, I don't have that data with me. The data is there, but I don't have it with me. I expect, frankly, it's a little bit smaller than the subject.
Okay, and why should we use the average CMHC price rather than the rent by year of construction?
Well, that's a fair question. They are all possibilities. They're all different metrics. You know, certainly year of construction is an alternative. But all I can say to you is by looking to the average, that takes into account the variables of location and year of construction and size of building. But you know, you're right, certainly that you know, year of construction is perhaps an equally supportable metric.
All right, thank you. Is there any summation that you wish, Ms. Ding?
No, I'm fine, thanks.
Mr. Newman?
I'm fine. Thank you very much.
Okay, thank you for your
Good morning
presentation.
to all.
Thank you. All right, the next item on the agenda is 85 Paget. Can you swear in the new applicant?
Well, Mr. Chair. Okay, Mr. Applicant, please state your full name, once you're ready.
Trevor Smith.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
I do.
Thank you. You may be seated.
Okay, I'm just opening the correct files here. Okay, so you can begin, Ms. Ting.
File number is 24-3695. Roll number is 100064411100. Address is 95 Paget Street. The assessed value for 2025 is $20,918,000. Page 2 of my brief shows the subject property information. So the property was built in 2012, and there are 106 suites. There are 48 indoor parking and 80 outdoor parkings.
Sorry, I'm
Sorry,
assessing.
yeah.
Are we not doing 85?
Which one are we?
Oh,
We're
sorry.
doing 80. We're doing 85.
Sorry. Wrong order. Okay, sorry.
You're
So
getting me confused.
sorry. Okay, I'll start again. File number is 24-4024. Roll number is 1000644120. Address is 85 Paget Street. The assessed value for 2025 is $21,719,000. The bottom of page 1 shows the subject property information. So there's one building with 4 stories, and it was built in 2008. There are 121 suites, 22 indoor parking, and 57 outdoor parking. Page 2 and 3 of my brief shows the subject property information. It is being used as a senior assistant living facility. Page 4 of my brief shows that there's no sales history for the subject property. And page 5 of my brief shows the subject property valuation. So there are 86 one-bedroom and 35 two-bedroom suites, and we assign an average monthly rent of $1,322.65. Then again, we use the 3.1% vacancy, 42.23% expense ratio, and 4.95% cap rate, and that gives us a market value of $21,719,000. And page 6 of my brief shows the comparable rent and comparable locations. And page 7 and 8 of my brief shows the CMHC information. And page 9 and 10 shows the cap rate study. And page 16 to page 19 shows the income expense information, and page 20 shows the subject property floor plan. And that's my presentation.
Okay, questions, Mr. Smith?
Yes, thank you, Mr. Chair. So my first question, I guess, is for the two properties that we're dealing with here today, given workload and the assessment department, I'm assuming you probably haven't had the opportunity to visit either property?
No.
Okay. And the valuation that the city has done for the subject property here as well as the next one. These are both model driven.
That's correct.
Okay. So that is based on the city's model that takes into account age, location, all the other facets with regard to rent being assigned. Is that correct?
That's correct.
Okay. Looking at your page number 8. So I see that the percentage of market rent virtually matches the market rent at just over 100%. Is that accurate?
I think so. If we're using the 2022 version of the CMHC data, then yes.
Right. Okay. All right. Looking at capitalization rate then. So the city of Winnipeg has for this property a cap rate of 4.95%. When I look at your page 9, the capitalization rate chart. So the city of Winnipeg's stated range there for all categories of multifamily, I see falls between a low of 4.75% and an upper end of 5.45%. So the 4.95% is towards the bottom end of the range of City of Winnipeg cap rates, correct?
That's correct.
Okay. And when we look at skipping forward to your page 10 and the capitalization rate evidence. So this particular issue was already brought forward in the prior hearing, so I won't spend a lot of time on it. Would you agree that 2390 McPhillips would be the closest in terms of comparability, in terms of year built, number of suites, etc. to the subject?
I agree.
Okay. And the city is aware of the discrepancy with regard to the cap rate that the city assigns to that particular property versus the capitalization rate that brokerages and agent representatives have assigned to that property based on the purchase being purchaser being aware that they could significantly improve the net operating income and return to themselves?
My understanding is that when we calculate the cap rate for 2390 McPhillips, we use the historical income and expense information provided by the owner. My understanding is that I guess the agent has been using the market, I guess income and expense information to calculate the cap rate for 2390 McPhillips. But it seems like different agencies using different net operating income for this property. Some agencies has 5.25% cap rate and some agencies has 5.79% cap rate. So it just seems they're very inconsistent. And we believe that we should be treating the comparables the same method that we're treating the subject property, which is to use the historical income and expense information provided by the owner.
Right, so the city is basing it upon the historical information up to the date of sale, but not taking into account what the property purchaser is looking at, which is the year following, essentially, correct?
That is correct.
Okay.
The financing term is not registered on the title, so it doesn't really impact the property right that we're appraising. It is still fee simple property right that is not impacted. So we don't look at those financing terms.
So just to clarify, the question that I had posed was not with regard to financing, but with regard to revenue and expenses. But those are all of my questions. Thank you.
Okay, Ms. Knight, any questions?
I do not, thank you.
Okay, Ms. Schultz.
Not at this time, thank you.
Okay, so this is basically an assisted living facility, is it?
That's correct.
And does it have typically of most assisted living, does it have extra common areas that a lot of the seniors residences have?
I believe so.
Okay. All right. Thank you. So Mr. Smith, you can give your presentation now.
Yes, thank you, Mr. Chair. So the first property we're dealing with here is 85 Paget, and yes, it is an assisted living facility located in the Fort Garry area. As you had just mentioned, Mr. Chair, there is a difference between a standard market apartment and assisted living facilities with regard to the amount of common area and different common area types, size of the common area versus a standard market apartment. This does lead to differences in valuation. So for the subject property, we have areas such as a dining room and associated commercial kitchen, which is typical of assisted living facilities where you receive your meals. They have a multi-purpose room, a sunroom, exercise room, games room, hairdresser store, things of that nature. These are all typically located on the main floor. In addition, there are spaces on each floor to serve as kind of a lounge area for the residents of the facility. So what we're looking at is a structure that has significantly more area that needs to be serviced and maintained than you would typically have in a market apartment. So in your standard market apartment, maybe they have a gym, but typically you have your units, you have your hallways, you may have as I said, one gym room or something of that nature, but nothing to the extent in terms of the amount of additional area that needs to be heated, cleaned, repaired, etc., that you would find in an assisted living facility. So let's look at this quickly here. Beginning on page number 3, we have the background for the property. This has already been covered, so I won't go through it in detail. We're looking at an age of 2008 with regard to the structure. Site area of 4.1 acres and a total of 122 units, one different, 87 one beds and 35 two-bedroom units. Now, what I will mention is that to a very small degree, they have allowed some non-assisted living rental of the units on a short-term basis as they as needed, but the majority of the facility is assisted living and is designed and intended as such. The that is the background of the facility. Site is shown on my page number 10. You can see site there. And the location of the property is shown on my page number 11. Skipping forward to my page 12, just have some text with regard to the seniors rental market. So there's essentially 4 broad categories. You have 55 plus rental projects. Then you move on to independent living projects where they have a greater degree of autonomy or need for assistance. And we have assisted living projects. And finally, personal care homes, essentially. That being kind of the staging of the seniors market. We can move into the valuation for the project. I will save us some time here in that we have 2 points that we have in dispute with regard to the city of Winnipeg's valuation. We're in agreement on rental income for the property. We're in agreement on the expense allowance percentage with explanation with regard to that point. But we are in dispute with regard to vacancy rate as well as capitalization rate. So those will be the points that I focus on in my valuation. There was also significant text in the body of the report to discuss the difference between valuing assisted living facilities versus standard market apartments. So I'll cover that off once. And we can move on from there. So with regard to income, we have provided the CMHC data as shown on my page number 13. In assisted living facilities, the rent and additional costs that you pay are reflective of the services that are included in what you receive. So we can't base evaluation upon that. That's standard practice. That is the way that these properties have been valued both by the city and by appellants for many cycles now. So there's really no dispute in that regard. The CMHC rents are shown for you there. We are not in dispute with the rents that the City of Winnipeg model has assigned to the subject based on that information. We can move on to the expense side of the ledger on page number 14. So we begin with vacancy. The top of the page. We have the CMHC fall 2022 Winnipeg market rental vacancy stats. These are for standard market apartments. as you can see in Fort Garry, bachelor apartments for 3.1%, 1 beds 1.4, 2 beds 1.7, with an overall vacancy rate of 1.7%. Winnipeg CMA overall were somewhat higher, with an average of 2.7% overall vacancy. Beyond that, though, CMHC does break down the vacancy statistics by rental rate range and bedroom type. So if you look at the bottom of my page 14, you can see that this chart gives you vacancy rates for City of Winnipeg based on stratification of rental rates. So the highest rental rate, which would apply to the subject property, $1,300 plus. If you look at the one bedroom, pardon me, one bedroom vacancy rate for that appropriate time frame, it sits at 4.3%. And the two bedroom rate sits at 3%, with an overall vacancy rate of 3.3% for that $1,300 plus rental rate range. Moving on, they also provide vacancy rate statistics by year of construction. So subject property being built in 2008, we're looking at the most recent classification there, 2005 plus. And similarly, if you look at the one bedroom vacancies, they sit at 4%. And the two bedroom vacancies sit at 3.2%, with an overall vacancy rate average of 3.4%. Now, subject property, we're looking at majority one bedrooms, 87%, or sorry, 87 out of 122 units, 35 of them being two bedroom units. So the bulk of the property is in the one bedroom size. Now, subject property, as is not unusual with these types of facilities, given their use and turnover, etc. In the valuation year of 2022, we were looking at a vacancy rate of 8.6% for the subject property. Now, the following property is virtually identical. There's no outlying reason for this, in that they're well managed and have appropriate professionals in place with regard to leasing the place up. Simply that their vacancy rate does tend to be higher than standard market apartments. Okay, so have we applied an 8.6% vacancy rate? No, we haven't. We're not applying that in our valuation, but we do feel that an additional reflection of the normal vacancy for property of this type is appropriate. So we've applied a slightly higher vacancy rate at 4% in our valuation. Moving on to the expense allowance. As I'd already indicated, we do have more main floor space and common area space that does need to be heated, cleaned, maintained, etc. As it would with if you had a standard market apartment that was identical to this with the same spaces. And what this drives is somewhat higher operating expenses than you find in a standard market apartment. For year-end 2022, we had a total of $1,091,933 of operating expenses once all non-real estate costs were deducted. When you look at the category that we're speaking about here, there does tend to be somewhat more wear and tear in the units themselves, as well as hallways with regard to repair being needed to paint edges of hallways, etc. With regard to incidents with assisted walkers and wheelchairs, etc. So you do tend to have more repair that is needed. Now, it's a little over $1 million there, nearly 1.1 million were the actual costs. If we were to apply that with regard to valuation of the subject property for the real estate, that would lead to an inaccurate valuation, significantly too low. So we're not using the actuals. What I'm pointing out is that the actual expenses are much higher, and these are not food expenses or staffing expenses or anything of that nature. This is purely real estate. So what we have done is examine the City of Winnipeg parameter in relation to the subject property, and we are deferring to the City of Winnipeg's expense allowance of 42.23%. which gives us the allowance shown on page 15, $778,581. Again, well below the actual expenses that the property incurs. We will take that into account with regard to the selection of the capitalization rate as well, which again is standard appraisal practice. So let's move on to most critical factor here, capitalization rate. And bear with me, there's a bit of text here that we will run through just once, I promise. What we need to do is distinguish the asset class and from standard market apartments here with regard to how they should appropriately be valued. So looking at the top of my page 16, it is recognized that independent living projects include a business component that makes a comparison to general market apartment properties somewhat inappropriate. Business component reflects the investment on behalf of the owner and staffing and equipment, supplies, etc. This characteristic of the property type would be expected to increase the risk inherent in the investment and should be reflected in a premium over cap rates for more conventional investments. In addition, it must be recognized that the marketplace for tenants in the independent living and assisted living universe is much reduced from the general market apartments, confined to an older age cohort, but also individuals that have the economic ability to pay the overall rents that are required, typically $2,500 a month and up, inclusive of services and as well as shelter. Both of these factors support the notion of a risk-related premium for cap rates for this type of asset. The additional insight into cap rates specific to seniors housing is presented in my addendum materials, I believe. The article from Canadian Property Valuation titled Valuation of Seniors Housing. Following graph extracted from the article presents a comparison of market cap rates for market apartments, seniors housing, and personal care properties. What I will point out is that what we're looking at here is not the time frame and the cap rates that are portrayed, but the spread that we're looking at. We're looking at the theory, not the specific numbers. So when you look at the national cap rate trend, obviously shows apartment high-rise A being the darker line at the bottom, followed by seniors housing A being the line above that. So if you look, typically we're looking at a spread of in the range of 1% to 2%. Now, again, I'm not specifically referring to a rate or a specific range of rate. What we're showing is that the cap rate that the market applies to this particular type of asset class is higher than standard market apartments. Following that, and again, the time frame is not the relevant material, but rather the theory behind it. CBRE poses in their seniors housing and healthcare Canadian cap rate survey in 2015, covering the Canadian market. They posed the question to the most active investors in this asset class, that being, what cap rate would you use to value a Class A independent and assisted living community in the following marketplace, assuming that the property was stabilized and it was a clean deal, no additional issues to be dealt with. What the chart following that shows on page 17 is the range of cap rates that these major investors would assign to that particular asset class back in that time frame. Now, again, we're not referring specifically to the capitalization rates that are shown there. What we're showing is that the cap rates applied are significantly higher than what you would see assigned to a standard market apartment. Moving forward to my page 17, CB, and moving forward in time to the valuation date, CB Richard Ellis published a Canadian Investors Sentiment Survey for 2023, in which investors were asked about their outlook on seniors housing cap rates for 2023. The chart shown below indicates the results of that survey. Only 5% of respondents foresaw no change in cap rates for 2023, with the remainder of respondents seeing between a 0.25 and 0.75% basis point increase in cap rates for this asset class for the 2023 year. So that is what the theory and the market investors and major market brokers are indicating is the proper framing of how to value this particular asset class. Cap rates are higher than for standard market apartments. So let's move forward into the capitalization rate evidence. So looking at the bottom of my page 17, we move forward into our evidence with regard to capitalization rates. One thing that I did not specifically include, but I've presented verbally in my evidence on other multifamily properties and other asset classes in this particular cycle, is the issue of lending rates, interest rates. So you've already heard in the prior appeal from the prior appellant, there was an increase in Bank of Canada interest rates between spring of 2022 up to the valuation date of a lift of from 4%, or rather, sorry, I'm turning them around in my mind as I present them, a lift from 0.5% at the beginning of that time frame to 4.5, 4.75% as of the valuation date. So you're looking at a change of 4% to 4.25% over that time frame. Now, what effect does this have? Well, if you're an investor in the marketplace and you're looking to purchase a property, the interest rate that will be applied to your purchase will have changed quite dramatically over that period of time from early 2022 to the valuation date. So what does this mean? It means that if you borrowed at that increased interest rate and paid the same price, the return that you would receive would be dramatically reduced. Now, that's not acceptable, obviously, to investors in the marketplace. What this change in interest rates did was two things. It drove up capitalization rates, and as they are very clearly linked, And it also caused a very dramatic cooling in the market with very few transactions occurring in that period of time up to the April 1, 2023 valuation date. So there's very little information out there with regard to sales on which to base either a City of Winnipeg model or a lot of transactions in that period. So really what we need to look at is what did happen in the market, as well as what is the environment as of April 1, 2023. So if you look at my page number 18, we present our capitalization rate chart. These are all transactions that occurred in the reference time frame between 2021 and 2022 in our chart. Again, there were exceptionally few transactions in that period leading up to the valuation date. These are not all brand new apartments of a similar size, of a similar location. What this does show you is what the what investor sentiment and return expectations are in the marketplace based on the capitalization rates that they were willing to pay for these assets in the market as of that time frame. So if we look at the range of sales that we're seeing here, these are generally all well-located, well-maintained assets that were purchased for their in-place net operating income and ongoing income. And you can see that the range of capitalization rates ranges from a very low end of 4.5% for a small unit, or rather a small property on Highfield, up to a high of 6.5% for a property in St. Boniface. Again, a significantly smaller property at 9 units transacting in 2022. Now, the bulk of these capitalization rates are typically in that 5% plus, 5.5% plus. For the most part, there are a couple obviously that are under the 5% range, but for the most part, what we're seeing is transactions that are occurring 5% plus in the marketplace. Moving on to the main market brokerages. Let's look at what the main commercial brokerages are telling us. So what I've shown on page number 19 is kind of a history of Collier's Canadian cap rate report. We do have a slight change to make to this. We received information from Collier's that they published after the fact that made a slight change to their 2023 numbers. But typically what we're seeing is stability in the Collier's capitalization rates. If you look at the 2018, 2020, and 2023 cap rate surveys, those being the years of the assessment, first year of the assessment cycle in Winnipeg, what we see is a great degree of stability. So high-rise apartments in 2018 and 2020 showing 5% to 6%. And this is where I'll make my slight adjustment based on the revised Collier's information. The 2023 information, they have adjusted to 5.5 to 6.5%. The low-rise apartments, again, 5 to 6% for 2018 and 2020, 5.5 to 6.5 for the 2023 Q1 report. So pretty stable, with obviously a lift being shown in that Q1 of 2023. Again, based on the interest rate environment that investors were seeing in that lead up to the valuation timeframe. Let's move forward to page number 20. This is Cushman & Wakefield Canadian cap rate survey Q1 of 2023. And they have two distinctions here. We have high-rise apartments for Winnipeg. They're showing 4.75 to 5.5%. And low-rise apartments, they're showing 5% to 5.75%. The bottom of the page, we have Cushman Wakefield's seniors housing report, or seniors housing cap rate ranges. And as indicated, for Winnipeg, they're stating a cap rate range of 6.5% to 7.25% for seniors housing A category, and 8 to 9% for seniors housing B category. Moving forward to my page number 21. Just essentially summarize this information as well as discuss premium that investors were willing to pay for apartments that they would be able to convert to have higher returns on. The main commercial brokerage information for the relevant time frame indeed supports capitalization rates between roughly 5% and 6.5% for or 5 and 6% for standard market apartments, and somewhat higher for seniors market apartments, or rather seniors housing, as we're dealing with here today. Now, our challenge is that we're not valuing the business here. We're not valuing the seniors housing business. We're valuing strictly the real estate. So the exercise is one of applying what an appropriate cap rate would be if this were a standard market apartment. So we need to take that into account. So the issue still remains that you have apartments that are designed for seniors. You have significantly greater, common areas that are in these facilities that have significantly greater operating expenses than you would have for a standard market apartment. The amenities are different, and the risk for them is significantly different as well. The issue that we haven't really examined is you have a seniors housing facility here with people in place. And if one were to try and acquire it as a market apartment, there's endless numbers of complications that are in place there. First of all, there's existing leases in place with the occupants of the units. They have the right to remain there under those terms. So there would be no easy transition from this particular set up as a seniors housing facility to a standard market apartment. So there are a wide number of additional aspects that increase the risk for acquiring a facility such as this as a standard market apartment over a traditional standard market apartment. So looking at both our evidence with regard to cap rates, the evidence from the commercial market brokerages, and the capitalization rate summary with regard to seniors housing, we have made an appropriate adjustment to capitalization rate. And we were applying a 6% capitalization rate, essentially at the top end of the 5 to 6% range that we're seeing from market brokerages, as well as, for the most part, our capitalization rate evidence as well. There's a slight error on my page 21 referring to 5.5. It's incorrect. We have applied 6% in our valuation. So if you skip forward to page 22, the summary is there for you. As I've already stated, we're in agreement with the rent. We dispute the vacancy. We've made a slight adjustment to 4%. Representing an appropriate vacancy for this type of property. We've gone with the expense allowance of the city of Winnipeg at 42.23%, despite the real estate expenses being just under 1.1 million. So significantly lower expenses are being assigned than what they actually have. This produces the NOI, which we capitalize at 6%. So the final market value, taking into account those factors, is 17,751,000. Before I wrap up, what I didn't address is investor sentiment as of the valuation date for seniors care facilities in Canada. So as we're all aware, we've just gone through the COVID-19 pandemic beginning in March of 2020 and carrying forward from there. We all watched the news and were aware of the issues that occurred at seniors care facilities across the country, as well as in Winnipeg, and the tragic nature in many instances of the impact of COVID on these particular type of facilities. Now, what this has done essentially is have a dramatic cooling effect on investors' appetite for this particular asset class. So, given the impact and how will we phrase this? The appropriate public outcry and concern about this particular asset class. It has certainly cooled interest in this particular asset class and thrown a great degree of caution into the acquisition of this type of property in the marketplace. So that also needs to be taken into account with regard to the cap rate that is applied to these properties. So our summary is shown on page 22, final market value of 17,751,000. The addendum materials include the income and expense submitted to the city of Winnipeg. And at this point, I'm happy to answer any questions you may have.
Okay, Ms. Tang, any questions?
So I guess for your vacancy study based on the CMHC information, that is just the average for the entire Fort Garry area. Is that correct?
Well, let's look at the appropriate page and make sure that I'm addressing what it is you're referring to here. So which chart are you looking at?
I guess the vacancy chart that you have on
Top of
page
14.
14, yeah.
Yeah, so I did identify both City of Winnipeg CMA as well as Fort Garry and the vacancy stats that they had for market apartments of the various bedroom sizes.
And on page 18 of your brief, that shows the comparable sales for the cap rate. Which comparable would you say is more compatible to the subject property?
Well, and that is the challenge that we have with regard to sales in that time frame, is that we didn't really have any sales of more recently built larger facilities that transacted in the marketplace. So we have properties that are typically somewhat smaller than the subject as shown, but what this does show is the general range of capitalization rates that that are out there in the marketplace as of the valuation date.
Would you consider the subject properties at a better location compared to your subject sales cap rate studies?
Well, the subject property is in the Fort Garry area, which is certainly a decent area. When we look at the cap rate sales, I mean, we're looking at Corridon Avenue in River Heights. We have Arden and St. Patel, very well located. There's a number in the St. Boniface area, Thomas Berry, Highfield, Cromwell, Thibault, that are also well located.
Okay, I don't have any other questions.
Okay, Ms. Schultz, any questions?
Just one question further to the vacancy rate. So the average vacancy rates that you had particularly talked about was for your standard market apartment. You had mentioned an 8.6% vacancy. That was on this particular property?
That's correct.
Were there any other similar properties, assisted livings? What were their vacancy rates? Seems particularly high, thinking I know sort of the waiting lists on assisted living seems to be very high these days.
Yeah, so I'll address that, and our following property is also assisted living and has virtually the identical vacancy rate. The waiting rate, or rather waiting list issue, yes, there's waiting lists for assisted living. There's also waiting lists for standard market apartments. This comes up very frequently. What you find is that the people that are on the waiting list don't necessarily take those units, and it doesn't translate directly into a facility that's always full. I know from personal experience, we had my father on quite a number of waiting lists when it was needed, and he of course only took one of those units ultimately. So the turnover that you see, I mean, there's two aspects to it. People tend to not move unless they move in these facilities. If they get into one, they tend to stay there until they need to leave for either greater care or other obvious reasons, which we won't get into. But there does tend to be greater turnover in that regard than one might find in a standard market apartment. So the vacancy here is mirrored by the one that we'll address following this, and they're very well managed and very well leased. So it's simply a function of the market.
Okay, so that 8.6 is at one point in time, or is that an average?
That's for the 2022 year overall.
Okay, 2022.
Not like you know, a single month or anything.
Right, because the other vacancy rates that you indicate, those are sort of an average from a certain period of time.
Those are the CMHC average.
2005, yeah.
Published their report, yeah.
Okay, thank you. No other questions, thank you.
Okay, Ms. Knight.
On your page 2, you claim there's 122 units, but when you're doing the calculations, you're claiming 121 units. So which is correct?
On my page 2.
Page 2, you say 87 1-bedroom, 35 2-bedroom for 122 suites, but you use a calculation on that. The heck page is that now? You use 121 suites when you're calculating.
On the potential rent, I think you were talking about.
So
on page 22, you
There
use
are
total
actually
units 121.
there are 122 units in the facility.
On page 22, Diane.
Yes, but on the first page, you're
I
saying
know.
there's 122 units. So which is it? Is it really 121 then?
It's really 122 units.
But you're only calculating based on 121 units.
So I didn't that, and I see what you're saying there.
Mhm.
The
The city says 121 units, you say 122, in your calculations, you say
It is.
121.
Yeah, and I hear you and see that. It is 122 units. The revenue and vacancy and expense allowance could be adjusted based on that. That is a very, very slight miscalculation. I'm happy to do the revisions if you would care for me to give me a moment to do that.
Yes, please.
17,898,000.
Thank you.
Seems to already have been done for me. I'm willing to accept that.
So what was that number?
17,898.
Thank you.
My apologies for that slight oversight there.
Okay.
But it is indeed 122 units. That's
Oh.
why we use that.
So can I ask the city a question then?
Go ahead.
Why are you using 121 units?
I guess basically it just depends on whatever the information was available at the time when they inspect the property and when they put the building on the roll. I guess in our system, if the if the information provided to us that was 121 units, then that would be the information we use.
Mm-hmm. So if he's telling you there's 122 units, did you want to make a change?
Probably have to
I
confirm.
think we want to verify the information with the owner before making any adjustments.
Okay, thank you.
Yeah, and at this point, the city couldn't increase the assessment without a separate application.
Right, which is what I thought. Okay, I just was asking the question.
Yeah.
Okay, thank you.
All right, that's all your questions. My only question was on the vacancy too, whether that was a point in time or an average vacancy. So you've already answered that question. So thank you very much. I guess we will take a break till 10:45 and then come back and do the next property. Okay, welcome back. We will now do 95 Paget Street. So, Ms. Teng, you can begin.
File number is 24-3695. Row number is 10006441-100. Address is 95 Paget Street. The assessed value for 2025 is 20,918,000. Page 2 of my brief shows the subject property information. So there's one building with four stories. The property was built in 2012. There are 106 suites, 48 indoor parking, and 80 outdoor parking. Page 3 and 4 of my brief shows the subject property pictures. Page 5 shows that there is no sales history for the subject property in the last 3 years. And page 6 of my brief shows that the valuation. So there are three bachelor suites, 61 bedroom, 43 2-bedroom, and that makes up a total of 106 suites. And we assign an average of monthly rent of $1,384.53. Then we use a 3.1% vacancy, 42.39 expense ratio, and 4.7% cap rate. And that gives us a market value of 20,918,000. And page 7 and 8 of my brief shows the comparable for the subject property. On page 9 and 10 of my brief shows the CMHC information. And page 18 to 20 shows the income and expense information submitted by the owner. And page 21 of my brief shows the subject property floor plan. And that's my presentation.
All right. Any questions, Mr. Smith?
Really just the same ones as the prior, prior property. This is all model driven as far as the valuation goes.
That's correct.
And, the city acknowledged the gap in valuation between the city's, valuation of 2390 McPhillips versus, the, appellant's, presentations previously, which I believe were 5.25% to 5.7%. Is that accurate?
From my experience, yes.
Okay. Those are all of my questions. Thank you.
Okay, Ms. Knight, any questions?
No, sir.
Ms. Schultz?
No, not at this time, thank you.
Okay, so Mr. Smith, you can begin your presentation.
Okay, thank you, Mr. Chair. So we have very similar property to the prior one. It is slightly newer, having been completed in 2012. It's adjacent to the subject property. And we have a total of 106 units as already referred to by the city. 3 of those being bachelor units, and then 61 beds and 43 2-bedroom units. So a slightly higher number of 2-bedroom units in this particular property. Slightly higher percentage of 2-bedroom units, which results, of course, in the slightly increased rental rate that the model has applied to the subject property. The same statements hold true with regard to not being able to value the subject property based on the in-place income for the property, as it takes into account the services that are provided for the residents of the property. So as is the standard methodology by both the city and appellants, we've applied market rents to it. Now, our valuation, and I'll save us again some time here, ideally, our valuation differs strictly on 2 points. That again being the vacancy that's applied and the capitalization rate that is applied to the subject. I'll cover the remainder of the details fairly quickly here. We do have photographs of the subject property beginning on page 4 onwards. These are the units themselves. You can see that the kitchens are relatively compact as such, as shown on page number 6. And the bathrooms take into account the mobility needs typically of the seniors population in their design. So they do differ from standard market apartments in that regard. And you can see on page number 11 just an indication of one of the lounge areas for the subject property. Again, for the subject property being an assisted living facility, they have the same degree of additional common area spaces, dining room, kitchen, etc., that our prior property had, with the associated impact on operating costs, etc. So let's move forward. Again, site shown on page 12, identical location, page 13. And we can move into the valuation itself. We looked at the city's modeling for the rent applied to the subject property, and we're not disputing that. We feel it's appropriate for the subject. And we can move into the vacancy issue. Same information presented to you. If you look at the vacancy for both higher higher rent apartments as well as more recently constructed apartments, they coincide, essentially indicating greater degrees of vacancy than other market apartments. When we look at the subject property, and this is what I was referring to in the last property, our vacancy rate for year end 2022, taking into account all of 2022, not point in time, was 8.4%. So we're not going to apply an 8.4% or 6% vacancy rate in our valuation, but we do feel that it's appropriate that a slight increase in the vacancy rate be applied based on the market statistics as well as the well-managed property that we're looking at itself. So we've applied a 4% vacancy. The expense allowance, as you see on page number 17, year-end 2022 expenses came to a little over $800,000, which is certainly somewhat higher than the city's projection of 42.39%. But again, in keeping with our valuation of 85 Paget, this would be would skew the valuation unreasonably. So what we've done is defer to the city of Winnipeg's expense parameter at 42.39. They actually have greater expenses than that, but we're not incorporating them into our valuation. Again, this should be taken into account when reviewing the capitalization rate, the appropriate capitalization rate to be applied to the subject. I've already covered our capitalization rate argument in detail. I won't go through it again. I'm certainly happy to answer any questions that the panel may have on it. My summary, I guess, would be that the main commercial brokerages are pointing to capitalization rate ranges between 5 and 6%, 5.5 to 6.5% in the case of Colliers, but 5 to 6% for the most part from the other main commercial brokerages for standard market apartments as of the valuation date. So 5% being the bottom end, 6% being the upper end. I've discussed the reasons that you would have significantly increased risk in acquiring the subject property and or other assisted living facilities versus a standard market apartment. And that increased risk would be taken into account by a purchaser in the cap rate that they would be willing to pay for an asset such as this. The seniors housing cap rates are shown there for you on pages 22 and 23. And then additionally, we have the significant impact that COVID-19 has had on the assisted and independent living and seniors care facilities in general in the marketplace, and the cooling of investor sentiment with regard to these type of properties. Did we just lose our feed?
The TV just flickers and but they're still
Okay.
Yeah.
Leading to obviously increased capitalization rates being appropriate as of the valuation date for that reason alone. The other thing that I will point out on my page number 19 is, again, specific to seniors housing, Canadian Investor Sentiment Survey for 2023 from CD Richard Ellis, in which investors were asked about their outlook on seniors housing cap rates for 2023. All but 5% were indicating upward change of cap rates between 0.25 and 0.75% of a basis point for 2023. So our summary of this valuation is shown on page number 24. Again, we're not in disagreement with the rental income assigned. We did increase the cap rate to 4% as shown. We deferred to the city's expense allowance despite the operating expenses being roughly $100,000 higher than the amount shown there. And ultimately, we've applied a capitalization rate of 6%, giving us our final market value of $16,233,000. Now, what I will point out is that could we have been higher in our capitalization rate that we applied to the subject property? I mean, this is all somewhat theoretical. Could we potentially have been higher given the ranges that the market brokerages are showing, some of the cap rates that we have seen in the marketplace, the investor sentiment, et cetera? Yes, we probably could have been at 6.5%, but we've been conservative in our valuation all throughout on both properties. Again, very marginal bump to the vacancy rate, more than adequately supported by the market stats as well as the subject itself. And the capitalization rate, again, this is not an aggressive cap rate at 6%. We've been conservative in what we've assigned. So this gives us our final market value of 16,233,000. That is my presentation. Thank you.
Okay, questions, Ms. Ting?
Yes. So on page 29 of your brief, it shows the I guess the income and expense information. And I guess the middle lower of the page, it shows
Sorry,
that
I
the
only
net,
have it 25. So which addenda page would that be? A1 or?
sorry, page 29. I guess
Yes, I'm not on
addendum
the computer, so
A3.
A3, okay. Yeah,
It shows the net income before amortization and debt. It was $1.24 million.
it does show that, yes.
Okay. And for the cap rate, for the Collier cap rate study, are you aware that they're using the net operating income for the 12 months following the date of sale divided by the purchase price?
To address your prior point, so the income on the income, rather the information on the income and expense that was supplied to the city is of course incorporating the full business of the assisted living. So yes, these will be significantly different than what the real estate would produce, as they include the services, and we both exclude those for obvious reasons. Your other question was with regard to Colliers and their cap rate.
That is correct. Are you aware that they're using the net operating income for the 12 months following the date of sale instead of prior to the date of sale?
Well, so, and I've had very brief discussions with Colliers with regard to this. The methodology that they apply is, from my understanding, based on what the investor would see for that property following the purchase, but it takes into account the prior details leading up to the sale timeframe as well.
Okay, I don't have any other questions.
Okay, Ms. Knight, any questions?
I do not, thank you.
Ms. Schultz?
I do not have any at this time. Thank you.
Okay, you mentioned it again, this for this property as well as the last, the impact of COVID. And people being reluctant to buy that. Is that not a business consideration and not a real estate consideration?
Is it a business versus a real estate consideration? Well, it impacts the real estate as well, as they're inextricably linked. The business is the facilities are built and designed for this particular use, so they are kind of inextricably linked. Is it there's what I can tell you is that there is a stigma attached in the marketplace with regard to seniors care facilities of various levels, whether they're seniors homes or independent living slash assisted living in the marketplace.
But aren't we this exercise we're trying to separate what the real estate would be by valuing it as an ordinary apartment and not as a senior's apartment. Is that not the exercise that we're engaged in?
That is the exercise we're engaged in, which is why I present all the other material with regard to the increased risk for acquiring facilities such as this, which is specifically designed for this type of use. The other point, I guess, that I would make, if we're looking at it in the manner that you are, it's not a standard apartment. You have units that have smaller kitchens, differently designed bathrooms, significantly greater common areas that would lead to expenses that would be higher. But then additionally, if the units are designed for specifically for seniors in that way, well, that would typically be what you would see, people that you would see looking to lease them on the open market, versus the greater degree of the market out there that would be looking for a more standard designed apartment, a normal kitchens, normal bathrooms, etc. So the smaller cohort, etc. There are lots of parameters that would again support the increased risk that you would see in buying this. If I were an investor and I had this building placed side by side by a standard market apartment built at the same time frame with the same number of units, etc., and I were to look at what I would pay for each of them, all other things being equal, I would pay more for the standard market apartment than I would for the facility we're looking at, for the reasons stated.
Okay, thank you very much for that. Okay, we shall move on then to 90 Paget in the same area. So can you swear in the new appellant there, Mr. Mohan?
Of course, Mr. Chair, I'm just gonna admit him in and make sure he's present.
Okay,
Thank you for your time, everyone.
thank you.
Take care.
Okay, thanks.
I will open the files at the same time.
Okay. Hello, Mr. Dupont, are you present at the moment?
He can't hear you.
I'm not sure. Yeah, not sure if he's present at the moment.
There's nobody there.
Can we call him?
I can, yeah.
Yeah, just let him know, alert them that his properties are up now if possible.
Sure. I know he doesn't wear his headset potentially, so I can send him an email first.
Shockingly, he's not following on the City of Winnipeg YouTube channel. There goes our only viewer.
He's done this so many times though. Mhm.
Our ratings are taking another hit.
Mhm.
Mr. Chair, are you okay if we have a quick recess so I can try to get a hold of our applicant?
Sure.
Thank you.
All right, welcome back. The next property is 90 Paget Street. So, Ms. Teng, you can proceed
Do you
with
have
that.
to swear him in first?
Oh, sorry, yes, you have to swear him in, yes.
Thank you. Mr. Applicant, please state your full name.
Henry Dupont.
Do you affirm that the evidence you're about to give at this hearing is the truth, the whole truth, and nothing but the truth?
Yes, I do.
Thank you.
All right, so Ms. Teng, now I was ahead of my time again, but now you can proceed.
File number is 24-2938. Roll number is 100064477700. address is 90 Paget Street. The assessed value for 2025 is 37,308,000.
Million.
Oh, sorry, 37,308,000. Yeah, 308,000. Page 2 of my brief shows the subject property information. So there are 2 buildings on the property and there are 7 stories. They were built in 2015. There are a total of 153 suites, 129 indoor parking, and 93 outdoor parking. Page 3 of my brief shows the subject property photos. Page 4 of my brief shows the income information. So there are 68 one-bedroom, 85 two-bedrooms, and we assign an average of $1,831.09 for the rent. Then we use 15% vacancy, 36.68% expense ratio, and 4.85% cap rate, and that gives us $37,308,000. And page 6 of my brief shows the comparable rent and maps. On page 7 and 8 of my brief shows the cap rate information. And page 14 to 18 shows the subject property income and expense information. And that's my presentation.
All right. Any questions, Mr. Dupont?
Yes. Your cap rate comparables are on page 8. Have you provided to the board how you arrive at any of those cap rates?
No, I didn't.
On 150 Hendon, you have a cap rate 4.01%. Did you consider the fact that the rents increased by 8.2% on the date of possession?
No, I don't think so. We only consider we only use the income and expense information 3 years prior to the sale date.
So you use the historical information and you ignored the actual rents as of the possession date. Is that what you're saying?
That I guess so. I didn't know that there is a difference between the sale date and the possession date.
No difference. That you can talk to a sale date as being the date the offer was signed, or else possession date's the actual possession date. And usually, for cap rates, etc., we show the date went to land titles or the possession date. So that's what it's meant to. Normally, the sale date. 2390 McPhillips, you got a cap rate 4.71%. Did you consider the fact that the rents would be at market or not at market at the time of sale?
Again, we just use the income and expense information provided by the owner. We assume that all the data was, I guess, market information.
You're not aware that this property was used as a cap rate comparable for 2023 and that was cap rate used by both sides. Are you not aware that the Shimichi rents were much higher than the actual rents and that the purchaser increased the rents substantially after purchase?
I'm aware that the rent increased after the purchase, but I don't know by how much.
Nevertheless, you ignored those market rents and or actual rents after purchase. Is there a reason why you ignore that?
We treat the comparable the same way we treat the subject property. So if we use the 3 years prior to the appraisal date, then we'll be using the same time frame for the subject property for the comparables as well. So if we're using, I guess, the future rent for the subject property, then we will be considering to use the future rent for the comparisons. But since we're using the historical information for the subject property, then we're using the same methodology throughout.
That's all the questions I have.
Okay, Ms. Schultz, any questions?
Not at this time, thank you.
Ms. Knight?
Just about the vacancy rate, why is it so high?
I think I think we take into consideration that the building is fairly new. Um, so I guess we give some I guess maybe after the next cycle you'll be back to normal. But I think right now the property is fairly new, so we do take into consideration that it does take some time for the buildings to lease up.
Okay, thank you.
All right, I have no questions, so Mr. Dupont, you can begin your presentation.
Okay, for this property and the property coming up, 100 Paget, we are disputing cap rate only. So we can shorten the process here.
Okay.
But so anyways, we can look at the photos, the first page, etc. And then there's a bunch of photos, but the income approach is the cap rate portion is on page 15. So based on our cap rate study, we come up with a cap rate of 5.25%, and we show the cap rates that we apply for certain age groups. So that our value is 35,358. So the page 17 is the spreadsheet for the income approach. It was built in 2015, so so by 2022, it's 7 years. We still have a problem renting in the market. You could see line 5 vacancy was 82% vacant in 2018, and 63 in next year, 37 in next year. So that's all part of the absorption in the marketplace. So it's been extremely slow. So that it's the market pushing back on the amount of rents they're trying to get from this place, and based on their physical conditions. So this is an interaction of the market. Now by 2022, they had 7.6% vacancy, and that's what we used. And I believe the assessor used 15%, which is shown on the second last column. But we use the actual vacancy, so we're using less vacancy. But nevertheless, if you go to line 33, our net income is 1,856,000, which is slightly higher than the assessor 1,809. So therefore, it becomes a cap rate argument, so that we have all the facts leading up to that, and then we have the cap rate. So the assessor is using 4.85, we were using 5.25, so we come to a value 35,358. The next page, we have this stabilization of repair maintenance. What we stabilize repair maintenance only 865, which is on the low end, meaning because it's still a relatively new property, and over time the repair maintenance will be going up to a more normal level, closer to 1,500 to 2,000 per suite. So nevertheless, it's stabilized at actual, and it's relatively low. So unless there's questions on this report, I can go to my cap rate report now.
Yep, go ahead. Okay, on your cap rate report.
Yes. So I have that on page 2. I'd like to point out something. So the paragraph after the quote, so I guess 1, 2, 3, 4, 5, 6, 7, 7th paragraph of the longer paragraph. Direct capitalization considers a stabilized first year net operating income. It processes that income into an indication of value. And then the last line of that paragraph, it says the more risk involved in maintaining the first year's income over the age life of the property, the higher the cap rate. So they basically talk about the first year's income, and the Collier's cap rate also stipulates that the cap rate is based on the first year's income. So it's not that we're stabilizing using the revenue expense after the sale. We're just saying we're stabilizing an income stream going forward. So we're not going backwards. So we're saying if part of the stabilization process is to say what is the income and expense we can expect going forward in the first year. So that is a proper way to do this. Now I've looked at some other board quotes, sorry, the quotes from the Appraisal Institute. And we don't have that in our report, but we should, and I'll give it to you verbally. Section 3.3 of the Appraisal of Real Estate Third Canadian Edition states, basis of income producing real estate is the future income that it will produce. Historical data on a property or a market is relevant only insofar as it helps interpret the current market anticipations. So therefore they're saying, sure, you can use historical data, but it's only relevant as to give you the current market anticipation. Section 20.1 of the appraisal manual, it says, in the income approach, an appraiser analyzes the property's capacity to generate income to the indication of present value. The principle of anticipation is fundamental to the approach. This is what we anticipate to be in the future. Section 21.1, historical income and current income are significant, but the ultimate concern is the future. Current income is a good starting point, but the direction and expected pattern of income change are critical to the capitalization process. Here they're talking specifically in regards to the capitalization process. So therefore, this kind of answers the difference in cap rate, where the assessor is going with historical data and ignores the current condition at the time of sale, and the fact that Colliers says that a cap rate is derived by calculating the first income. Now, I can quote what the Colliers report says specifically under glossary. It says that a capitalization rate is a property's net operating income for the 12 months following the date of sale divided by the purchase price. They don't say anywhere as they use the revenue and expense of the following 12 months. It just says capitalization rate is the stabilization of the next 12 months. So they're following the appraisal manual is that what you use historical to stabilize the next year's or the first year's income. So the cap rates that we have, so we were speaking the mortgage rates, interest rates went up. As you probably are all aware of that. So we talked about that in our report also. Then we have the actual comparables on page 11. So we have 4 comparables. The first 4 are smaller properties built. The first 4 built 1913, 1970. 100 Maryland is built 2017. So that one is newer. It's smaller though. It's 11 suites, and that cap rate we have is 5.44%. The 2 main cap rates for these properties here today are the next one, 150 Hendon and 2290 McPhillips. 150 Hendon is calculated at 5.42%. So that's a larger property, 59 suite, but the sale price $6,858,000. So that it's more professional people are buying that. They're not the mom and pop. So these are the more reliable cap rate based on normal criteria, going to a lender and getting the lender's criteria instead of borrowing from the small properties. May be doing different financing than normal. 2390 McPhillips, 90 suites, built 2015, calculate 5.59%. So we have comments on there. So that both of those, we're using the rents, the market rents at the time of sale. 150 Hendon, we're using the rents to actually achieve with the RTB ruling. The residential tenancies branch, they had approved an increase of rent, 8.2%, and that's what we use. At 2290 McPhillips, we use market rents. So the actual income approach follows, and we can go to page 19 is the cap rate on 150 Hendon. So if you go there, you'll see that the 2020 historical revenue and expense, the revenue was 596,929, but the vendor applied for a rent increase beyond the guideline prior to the sale, which would be likely right after they got their financials for 2020, so January, February of that year. And they sold as of June 1st, 2021. So therefore, and the rents that they got at the time was 712,182, and that's what we put on our stabilized. And we use the revenue and the expenses for the other items. We use also the laundry and parking expenses that are shown for 2019, 2020. So we use the historical to stabilize all the other items except for the actual rents in place at the time of possession. Line 27, you see that the repair maintenance increased from 53,000 to 59, and then last 2 years 105, 114. So they had improved the property, and part of that is that they can use those increased expenses to get approval for RTB, so that they've improved the property. They got the RTB, so therefore physically the property is superior than what the historical would indicate. So the RTB rents that we use reflect its conditions, its improved conditions. So the remarks is vendor applied for above guideline rent increase for RTB. The RTB orders are effective date of June 1st, 2021. And then we had a 2021 IE, which is a partial year. But the purchaser stated on that questionnaire that the potential rent was 712,182, exactly what the RTB had. And then we had the 2022 shows that the rental income was 709,313. That was achieved after discount, so that to show it's after the possession date, but it shows that they were able to absorb those rent increases without significant discounts for vacancy, so that it's after the reference date, but it shows that the actual rents approved were absorbed properly. The next one is 2290 McPhillips on page 20. It shows the historical. So line 3, the historical had rents of 1,445,095. We stabilized 1,649,880. The rent for a new property was only $13.39 per suite per month, which is below market. If we use the CMHC 2020 rent data, we would get higher rents, and we actually use here the actual rents that the purchaser achieved right after purchase, so it's part of their ad, and that's the rents that we use there. Other remarks, we say what the difference with CMHC and pro forma. The CMHC rents were 104 more for 1 bedroom, 184 more for 2 bedroom. The purchaser increased by the rents by more than CMHC rents indicated, so they got more than that. So the appendix, the data further on this is shown further, and I'll find it and let you know where it is. On 50 hand and page 86. So I have the cap rate calculation there on page 86, but then after that we have all the documentation on that. So the page 87 shows the rent increase, the order that the residential tenancies branch gave, and it shows the rent from to for each individual unit. So that was for one unit. Number 37, we asked the current manager, Shiniko, to provide us with a couple examples of those orders. And so the is dated July 14, 2021. And then under the order second paragraph, it says effective June 1st, 2021. So they sent that to the purchaser so that it was a application to increase was with the vendor, but by the time they got it approved, the approval was sent to the purchaser. So we have a second order here for another type the bedroom as to how much it went up by. And then we have the financials and the questionnaires, etc. And I don't believe there's that much difference with the assessor, except for the revenue. So page 92 is the 2022 revenue. It shows that they are getting the sum 12 in revenue. Rent discount was very low, 2,844. And the vacancy was also relatively low, 10,000.
Is that your presentation, Mr. Dupont?
No, I'm still going to my
Okay.
to see which other page I should show you. Then we have 2390 McPhillips. We went through that, and maybe I'll just go straight to the ad that the purchaser had, which is the ad starts on page 112. And then page 116, it shows what the rents are, what they're asking for rents at that time. So that would be my submission on cap rates. I would have a rebuttal report to the assessor's cap rate, but can present.
Okay,
later.
we'll do the rebuttal after questions. So questions, Ms. Ting.
So I guess I just want to clarify. So I guess we should be using, I guess, the net operating income after the reference date or after the sale date to calculate the cap rate.
We should be using the historical data
Okay.
to calculate the future income going forward. So a purchaser with buying this is what can I expect from this property? They're not going to be buying on the historical, they have to stabilize that. So you use the historical and the current rents that are known at the time and to calculate what your first year's net income is. And that's the process the Appraisal Institute state you should do. And that's the process Colliers say that they did. They did not stabilize the year after purchase. They're not using the revenue and the expense for the year after purchase. You're stabilizing to show the anticipated income stream for the first year.
So do you know what the anticipated income would be for the subject property?
We're using the actual revenue for 2022 to determine the anticipated income going forward.
Right, but the rent that you're using in the calculation is the anticipated income for the subject property?
We do that for all properties similar to the assessment department. The only time we would vary from that is when we know that the market rents are higher, or we know there has been an increase above RTB. So if there was an increase above RTB, like on Hendon, we would be obliged to use those rents. Otherwise, we're hiding a big increase RTB. So if the assessor told us, hey, they have had an RTB increase greater by April 1st, 2023, we would use that. And we do that for commercial properties at all time. We get the rent rolls as of the end of the year. The rent rolls as April 1st, 2023. If you have a lease increasing substantially, a 5-year lease increasing substantially, we would use that lease.
So can we use, I guess, the December 31st, 2023 income and expense information for the subject property and apply the 5.25% cap rate to generate the value then?
No, we cannot use the year after. That's post-reference data.
Okay, so are you aware that we're supposed to be treating the comparables the same way that we're treating the subject property based on the appraisal theory on page 5.6?
Yes, I'm aware. You should apply the cap rate, calculate the cap rate the same way as you apply the valuation. So it's a principle that everybody should follow, and I believe that's what we're doing. We're following it.
And for the subject party, you're using the average between 2018 to 2022, but you're using a different methodology for your comparable cap rate studies.
Average for what item are you talking about?
So on page 17 of your brief, that shows the, I guess the workup. So that shows you're using the data from 2018 to 2022, but you're selecting the data for your comparable cap rate studies.
So what's the question?
I'm just saying that you're using 5-year stabilization. So if you're using the same methodology throughout, you should be also using 5-year stabilization for your comparable to generate cap rates.
I believe my cap rates are 3 to 5 years, similar to yours, so that we're using the historical expenses to anticipate what the expenses will be for the first year of income.
Okay, so for page 12 of your cap rate study, 345 Talbot, that shows only 1 year income information.
Yes, yeah.
And page 14, 677 Maryland also shows 1 year.
Yes.
Okay, I don't have any other questions.
Okay, Ms. Knight, any questions either on Mr. Dufont's main presentation or his cap rate study?
Yes, at the very beginning, you said the only issue we had was cap rate. Is that correct?
Yes.
So when you're talking about net operating income, they're both different. So which one are you using? You're saying that the city's net operating income is fine?
Yes. Yeah, we're very close, so that we show our NOI, and I guess we've done a site-specific analysis. So you should probably use our net income, which is slightly higher than the assessor.
Okay.
But it's a choice the board has to make. But what we are using is our own stabilization and net income, which is very close, but slightly higher.
Yeah, I got you. Thank you.
Okay, Ms. Schultz.
On the when you're looking at the vacancy rate, so the city's using that 15%, but you've got 7.6%. So which is going to affect your bottom line as well as your net operating income?
Yes, so that's what we use, so that we went site specific, and the assessor went 15%, which is not the normal vacancy they do for this type of property, and so they were looking at the actual vacancy. I'm not too sure why they went 15, but we went with site specific at 7.6.
Okay, thank you.
All right. I guess, Mr. DuPont, I'm trying to balance your argument to use the future income based on the Broadway Square decision that said we can't consider post-reference material. Um, if if a property were to sell on March 31st, on the reference year, then we would be unable to consider future rent increases to value that property, would we not?
Yes, you cannot consider post-reference data. So what we're saying, and what the Appraisal Institute is saying, is you use the historical data and the current data to determine what the anticipated first year income. So you're not using the first year income. So I want to make that very clear. We are not using the first year income. We're not using the first year expenses, because that's after the sale. We're saying we're forecasting the first year net income. So that's the purpose of stabilizing. So when we're stabilizing, we're not stabilizing when we have subject stabilized, and same as the city subject stabilized. We're using the historical data and the current data to come to an anticipated first year income.
Okay. All right. You said you had rebuttal 2% as well?
Yes.
Is it in our folder?
It is.
See it yet.
It should be, Mr. Chair, and
Oh, there it is, yeah.
Assessor, I just sent it to you, so it might be a couple moments.
Yeah, it's there now.
Let me see. Altus rebuttal. I see it. Okay.
Madam Assessor, do you have it? It just left the inbox.
I just got it.
Okay, perfect.
Okay, on your rebuttal then, Mr.
Okay.
DuPont.
So the first page, we show the assessor's cap rates, and that's what we're rebutting. We show the mortgage rates, cap rates, etc. Which are higher. Now, page 4, we show the rebuttal on each one. Sum 27 Sergeant, 241 Young. The cap rates the city has 3.46 and 4.21. They're very low, unusually low, and below a 5-year GIC rate. They're also in poor locations, and often in poor conditions with potential to increase the rent. They're not comparable to most other apartments. The city does not show the income approach nor the supporting data to arrive at our cap rate, so we should not be giving any weight to those two. 459 Sergeant. The city has used the historical income and their cap rate stabilization, and the MLS listing states that the annual gross income was 101,142. And shows the average rent and shows the parking they had. So the purchaser would have based their purchase price on that income stream. So that historically you say, this is what we had in the past, but now we have rents of so-and-so. So a purchaser would take the current income into consideration and not only the historical. And so that is the proper way of doing that. So the assessor is ignoring the facts known at the time of purchase. So using the cap rate with the known rents at time of sale is cap rate is 5.79%. And we have the calculations next. So we just plug in the rents that are known at the time of purchase. And we also have the municipal board decision. It says you should use market rents for different types of properties, and that's usually for commercial, industrial property. But it's a principle we should always use. So if we know market rents or actual rents are higher than the rents from the last year, we should use that. That's a principle we should use. 150 Hendon. I don't want to spend too much time on that because it's part of our direct information, but it's a rebuttal to theirs, saying our direct information is actually rebuttal to theirs, so that they are ignoring the rents that were approved by RTB as of the possession date. And we have the calculation there, and we have the RTB orders. And actually, page 10 of our cap rate rebuttal gives some extra data. We give the RTB decisions that they gave the reasons for the decisions. Whereas before we had just given the actual orders for a couple of suites, but they're basically just showing their methods that they compare the increase of expenses, and from that they are able to calculate what the approved increase. And it says that the landlord applied for 8.34, that's shown on page 10, and the final approval is 8.2. So they basically nitpick the facts that are coming
I
in.
don't think we need to go over
Yeah,
these
okay.
properties. We've gone over them before.
Yeah, okay. Then we have further rebuttal for page 23. 677 Maryland, they're number 6. The city's using an older sale in 2020, and when they had a newer sale on March 1st, 2023, the sale price went down. We're using the newer sale, so I believe it's improper for the city to use the older sale. 2390 McPhillips, we've gone through this already, so our own direct evidence goes against them. Summit of St. Mary's, it shows that the purchaser bought with the intention to renovate. And then page 25, the purchaser bought also with intention to renovate. There's pretty ad showing that they had renovated right after purchase. That's 32 Arden. And I believe that's the with that we have some other the information to that, but that would be our rebuttal report.
Okay, Ms. Tang, any questions on the rebuttal?
So I guess I just want to clarify. So the rebuttal evidence is basically just based on the market rent to calculate the cap rate?
On some of them, 3 of your comparables, and actually it's the actual rent. So we use 2390 McPhillips. We use the CMHC rents to compare, but we also use the actual rents that the purchaser got. And 2 others, Hendon and I believe Maryland, we use the actual rents known at the time of purchase.
So there'll be I guess the actual rent after the purchase.
No, the MLS listing saying, and the one that our rents are now so and so, and
Okay.
the RTB listing for Hendon is that the rents in effect on the date of possession, with the application done prior to that, being known to the purchaser. So those were known things, and then McPhillips is CMHC market rent, indicating that it was below market rent, and then the purchaser's rents afterwards.
So I'm just wondering why you're using different methodologies for 2390 McPhillips versus the other comparables. When the appraisal theory said that we are supposed to use the same methodology for the subject property and the comparables.
We're using market rents as of the date of valuation for all of them. When we do our properties and for cap rates.
I don't have any other questions.
Okay, Ms. Schultz, any questions?
Not at this time, thank you.
Okay, Ms. Knight.
No, sir.
All right, so we will move to our last property on the agenda. Let me again open the files. 100 Paget Street. So you can begin, Ms. Tang.
File number is 24-2940. Row number is 10006447-600. The address is 100 Paget Street. The assessed value for 2025 is 39,834,000. Page 2 of my brief shows the subject property information. So there's one building on the property with 6 stories. The property was built in 2011. There are 130 suites, 78 indoor parking, and 83 outdoor parking. Bottom page 2 and page 3 of my brief shows the subject property photos. Page 4 shows that there's no sales history for the subject property. Page 5 of my brief shows the workup valuation. So there are 26 one-bedroom, 104 two-bedrooms, and we assign monthly rent of $2,106.91. Then we use 3.1% vacancy, 38.09% expense ratio, 4.95% cap rate, and that gives us 39,834,000. Page 6 and 7 shows the comparable information, and 8 and 9 shows the capitalization study. And page 15 to 19 shows the income expense information. And that's my presentation.
Okay. Questions, Mr. Dupont?
Can the cross-examination for 90 Paget be also considered for this one, or should we go over this again?
If you could just give us the bare bones of it.
Okay, on your cap rate comparables, are you showing any supporting data or any income approach to show how you derive your cap rates?
No.
And would you agree that on at least 3 of the comparables that you're using the historical rents and not the rents known at the time of sale?
We did use the rent at the time of sale. We used the 3 years information prior to the date of sale.
And the one property had an MLS listing saying that the rents had increased when they were listing the properties.
We only use the information provided to us by the owner. We don't use any other data.
Okay, so you would agree then that your statement that you use the rents at the time of sale is not necessarily correct if the MLS listing showed that it had higher rents at the time of sale?
I assume so.
That's all the questions I have.
Okay, Ms. Knight, any questions?
No, sir.
Ms. Schultz?
Nothing at this time, thank you.
Okay, thank you. Henry, your presentation, please.
You should go to page 15 of our brief. Cap rate argument only. Line 33, our net income is 2,004,064 versus the assessor 1,971,000. So we're slightly higher, quite close. This property was built 2011, so it had more time to absorb. The top right shows the average square feet per suite is 1468 versus 90 Paget, which was 1100. So they have much different square footage and different suite mix, etc. So it has higher rents and lower vacancy because of that. So it's a cap rate 5.25 we're using on this property. And we like to introduce my cap rate study, which we went through before. And the cap rate rebuttal also same as what we had before for 90 Paget. I would like that to be introduced as evidence.
Okay. All right. Any questions, Ms. Steng?
No, I don't have any other questions.
Okay, Ms. Schultz.
No questions, thank you.
Ms. Knight.
No, sir.
Okay, we've now heard all the properties on today's agenda, so this hearing is now.
Sorry, Mr. Chair, before you adjourn, Mr. Dupont, Mr. Applicant, is your rebuttal being applied to this item as well?
Yes, it is.
Okay.
Yeah, he did mention that, yes.
My apologies, Mr. Chair.
Okay. All right, so this hearing is now adjourned. Thank you. Thank
Thank
you
you.
for your capable presentations as usual.
Thank you.
Okay, and we'll take a short break and come back for our deliberations.